Hello, ladies and gentlemen, and welcome back. For the first time in 2023, the market seems to be finding a crisis point. This is an area where some of the news is maybe not as bullish as the market had intended. Higher for longer is the story. Interest rates have changed drastically since last Friday and the non-farm payroll number. So with Jerome Powell from the Federal Reserve coming out to have a speech, and on top of that, a critical zone in markets, let's deep dive into stocks, commodities, and cryptos to see their next moves together. Well, welcome back everybody to The Daily Show, where we talk about the news, the macro, the lead indicators, and of course the key levels that you need to be watching on the markets right now. But we'll begin with the news stories, and I think a big one here is there's a few people starting to call some pretty big drops. David Rosenberg here said that the market is expected to lose, or he expects the market to lose another 30%. And I think there's an important lesson in here that maybe some people have forgotten, and it will most likely, based on statistics in the past, provide an opportunity for traders and investors later on if you're patient enough to wait for it. So he said the recession is just starting, and basically the market bottoms typically in the 6th or 7th inning of the recession, deep into the Fed easing cycle. Remember, when the Federal Reserve tends to pivot, what actually happens is the market actually drops after that and then starts to pick up during the pivoting period. It's actually only reacting to a very poor circumstance. Pivots mean the economy's sick. So if that does happen, it makes sense that maybe at the beginning, at least, stocks do go down. Investors can expect to endure more uncertainty leading up into that time. Totally agree. It's going to be a very interesting 23, and it will come, he said, when the Fed first pauses its current run of interest rate hikes and begins to cut. So is this a fair statement? I think there are some lessons to be learned here that maybe some of us have forgotten about recently, and that is that it's actually expected that markets rally into often pivoting periods or even into these areas of so-called soft landing rhetorics. And then we move into a period of, oh, wait a second, what's actually the damage done to the economy? That's not actually even being questioned right now, how much damage is being done. Eventually, it will become the story. Now, let's put things back in perspective as well. Follow us over at Twitter if you're interested. We post a whole bunch of extra stuff there that we do use in these videos, and of course, some extra charts as well. But let's have a look here. Just to put things in perspective, Facebook from top to bottom dropped 76.7%. Basically, as of the time of this recording, yes, it went up 109% from the bottom. It's still down 51%. And it's a similar story with Tesla. It's the similar story with Shopify. There are still opportunities for investors in these markets if you have a longer term approach. The key is to understand whether you really are trading, or investing. Remember, if you're trading, you don't really care about where the market's at. You shouldn't feel FOMO or fear in that aspect. You're just looking for opportunity. Trade investors, probably the scariest times are when markets rally because you're trying to buy the dip and then sell it off. I'm sure there's a few of you out there. And then, of course, investors, you're just trying to find the best statistical odds to pick those prices up. Now, let's talk about the market conditions right now in terms of rotation. What's going on? Well, we do have some defensive moves. This is like the first time or second time in 2023 we've seen a defensive sector out in front. It's amazing. It's pretty big here. Utilities, staples, and even healthcare wasn't down that much. So we do want to see those trifecta combos being some of the top sectors. And if they stay in the top for like usually around 2, 3, even 4 days, and we're seeing kind of consolidated price action, it's usually a good sign that the market's getting ready to dump. Remember, rotationals are a huge part of how you can figure out what Wall Street and the composite man are doing in markets. So we mentioned before that things are getting wild on the interest rate front. Here is an update of the changes in interest rate. And you can see what happened in 2022 and you can see what happened in 2023. More rate cuts faster was the story. And of course, the market liked this, especially in tech stocks, and bought them all back up because, of course, rate cuts, well, that's perceived to be good for debt-laden companies, and it made sense why they would run. Now we see, though, that since the non-farm payrolls number, all of a sudden less rate cuts and not as low on the end rate before they start to do some hike cycles later on. Remember, the bonds market is really the best predictor we have of what's going on in the markets because stocks trade 12 to 18 months in the future. They don't trade in the present, they trade in the future. So look at these things, make sure to follow the channel. We always deep dive into those types of charts. Another thing that you will want to think about when looking at the future, and I believe this will become very important should the Fed pivot at some point and markets actually fall based on that pivot, it's to keep in mind optimism, to keep in mind forward PE ratio and the averages. Remember, the average of 25 years is 16.82. We're actually not trading that heavily above that. We're about 18 and a bit right now. And what this means is that, yes, an investor could come in and say, well, at least it's still way better value than it was during certain other times in the markets. Historically, it's still pretty expensive, but whenever it gets underneath here into those 15s, those 14s, those 13s, you have to seriously ask yourself the question, should I be optimistic right now? And that brings us on to fear and greed index. Now, a lot of people have been using this like it's some kind of gospel. Remember, it's a great, I guess you should say, indicator to show you that, yes, there's a little bit of froth in the markets, but it won't show you a turn. The other day we hit 80. So we hit that extreme greed. We hit 80 just before non-farm payrolls. Since that point, we've dropped off a little bit. And this takes into consideration momentum, breadth, everything else that is usually considered in markets, put-call ratio, etc. And it's a cool indicator, but you do need to just think about it as it can stay in extreme greed or extreme fear for some time. It's good to stack with other reasons should you want to use it. Earnings beat data throughout earnings season, 66%. It continues to actually rise. So the start of earnings season was worse. Then it got better. Then it got bad for some of the tech stocks. And now it's getting better again. Beats 493, misses 257. Not too bad on the earnings result. I would have expected worse by now. It's not good. Of course, expectations were low, but the big major tech stocks were the ones that disappointed. And of course, they've led us to where we are technically, which is some pretty exciting levels. Here are the big earnings season results for the week. So we've got, of course, the Tuesday, we've got Chipotle. That's expected to be the highest implied volatility move for the week. Then we have Uber as well, Disney coming out, PayPal as well as a big name, and a whole bunch of others there. These are all the expected moves based on the options market. So do remember, if you're trading these ones, get ready for your risk management because the moves would be big. Last week we saw, I believe it was Meta, and we thought it was going to move about 10%, ended up moving 20 after the market. So if you've got a high IV, it can get even more wild. If you haven't already, come and follow us over on a couple of our socials, links in the description down below. Remember, we have 3 free trading cheat sheets if you're interested. Follow us on TikTok. We're going to start producing some little snippet content there, which I think will be really valuable to you guys. And if you like any of our other socials, of course, follow us by those links. Let's move now into the charts. Not much to say on the VIX. A lot of people claim this is broken. I don't believe it's fully broken or anything. It's just doing what it should be doing. When you're in basically known territory on markets, VIXs don't tend to be as freaked out. If we were at 3,300 on the SPY, the VIX would be skyrocketing out of control. So just remember, it's not necessarily broken. It's just that people aren't used to it being low because for about a year now, we've seen a lot of spikes every time it's sold off. I do want to just point out this watch the reaction around 16.37. Should we hit that level, I believe we might be hitting a 43.50 plus, and we'll talk more about that later on. It's kind of like the last stand, I believe, for bears in these markets. Now, here's the concerning part. Check this out. US 2-year, I mean, you would think the market should be down further based on what these yields are doing. They've moved from basically 4.05% to 4.4% since non-farm payrolls. The Friday and this Monday trade pushed these huge. Now, this is a big switch because if you load something like the SPX on top of this, so we'll load up the S&P 500, what you might notice is that previously when we were at these rates, we were sitting at kind of like 3750s and even lower points. Now, it's the fear of the unknown that Wall Street hates. But if you ever see a spike up here, which would always be worth setting an alert for, the markets will be freaking out at that point. Now, I'm not saying we're getting there, but this is starting to look very different to the terminal rate. So if we load up the terminal rate here and we think about where the Fed is expected to go, we've now topped back over 5% for September of 2023. That's a huge move. Again, it's expecting now that there's a real potential that the Federal Reserve will go to 5.25%. Now, if they push that, and if they go another one, like 5.5, I've long thought that's where like kind of the breaking of the US economy will be. Above 5% is a big deal, I believe, psychologically, and just what the market is going to freak out at. So the higher this goes, if the stock market is rallying, you have to be incredibly careful. That is not good. So do watch this. There is now almost no rate cuts expected as of 2023. It was 2, then it went 1. Now it's kind of hovering between 1 and 0. So it's a massive switch in yields over the last couple of days. That's why I want to spend some time on it. Now, because yields switched, that is, they went up, what does that mean for the US dollar? Well, it becomes more desirable. It's simple maths. I mean, if you go and put money in the bank and you're earning more interest on that money, well, that's pretty good. That's a good deal. So cash-free, or basically risk-free investing, has theoretically become more desirable, and cash has become more desirable during this point. Now, traditionally, during the type of market we're in, and this is where the question is, I'm going to ask you guys to put it in comments down below which one you think. Are we in a stagflation market, or are we in a deflationary bust? Obviously, deflationary busts are also known as kind of crashes or mini crashes. So are we in the mini crash, or are we in stagflation? Do we have sticky inflation? This is a big one. In both stagflation and technically market or mini crashes, cash is king. It's actually pretty good in both. But during stagflation, gold also becomes a big one. And of course, some commodities become big. During deflationary busts, we tend to see treasuries do a lot better, which we'll look at in a second. But let's go over this dollar index, because we kind of navigated this fairly well, I believe. We weren't necessarily run over by this idea that the market would take this low. We saw the non-farm payrolls. We obviously thought we had to pay a lot of attention in here. But if we looked at the market, which we did in the weekend video, we saw that it just busted through that level, no rejections. So we found ourselves at one of our key alerts in the previous session. You'll notice I've got kind of like a large fib drawn on the current market conditions. If this market drops down and actually breaks under something like this level here, which is 102.88, I could actually see the US dollar weakening for a period, but I think there's a lot of buyers that will recommence or try to recommence around that 101.70 zone. And that's that previous block that led to this huge move, and also all this structure. Remember, on a weekly, what this structure looks like is 2 long leg dojis, and then we've got the wick coming off the bottom. So there's a lot of probably potential buyers, that is Wall Street composite man players, big players in here. And at the moment, the dollar index is certainly quite strong, and rightfully so. Next key levels, should we continue to bust up, would be around this alert zone, which is 105.15. And that takes us into that next resistance area. So very interesting here on the US dollar at this stage. Let's move over to TLT and we'll look at bonds. So treasuries don't like increased interest rates, therefore they have dropped. I'd like to see treasuries get back into this level. I don't know they're going to get there. It's still probably one of my favorite trades of 2020. Well, not really trades, more of an investment concepts for the longer term, because you get paid to hold them. And on top of that, they tend to do a bit better if we expect rate cuts due to a sickness in the economy. So at this stage, yes, these are very, very interesting. Let's have a look at HYG, because that's what we've used with the stock market. And it was another poor session for high yield bonds. Now, high yield bonds are basically junk. Do we want to hold junk during these periods? Well, traditionally, no, I don't want to hold junk. And junk bonds are not something I've been buying into. But you'll notice I've got this little alert, 75, 74, somewhere between there and here. If the market breaks through, and again, we see stocks continue to rise, we have to be concerned about that move. And this is a very, very important point for stocks. Either here, or if we break a new high, which we'll look at on the S&P 500, the next kind of 150 points past that area have to be where the bears recommit. And if they don't, then we have to really question whether this is actually all part of a fully fledged rally, because that's a big thing, and we will get the soft landing and all the magic will happen. It's going to be a big point. Let's check out gold. As you might notice over here, gold's on a pretty significant trend line. It fell off. Gold hates yield increases, so it really hated what happened on the non-farm payrolls and got absolutely destroyed. It's fallen just underneath here, but it's structurally basing. I've kind of suspected that if the DXY does weaken at these points and we see that kind of shift move, then we should technically have gold rallying into somewhere in this green box. This is where sellers would recommence themselves into gold. And at this stage on the weekly and other things, gold does tend to look pretty bad. And this was what we were looking for. We believe that gold would run for Jan, obviously the previous months as well, and then February would be weak for it. So far, I guess that storyline is coming through. Copper continues to be pretty much weak on the charts, looking for copper's reaction around this trend line. It's very close. Notice the doji at this stage. Maybe we get a little rally in copper, but overall, I'm looking for it down into these areas here, which is around that 3.92%. So definitely watch copper on the charts. US oil, it's pretty weak. It did make a new low though, and then bust that. So for buyers of oil, if you're a buyer, you'll want to see a little bit of a pullback over the next 24 hours. And then somewhere in this area, through this range, 73.40 kind of area, I'd be looking for potential buyers to recommence, push into here, and then that's where the bigger sellers should theoretically be if they are going to push oil down. We've talked about $65 a barrel a lot. This is a tough trade to take now. Anywhere around 70, the US government's kind of all over that as well. I don't really think oil is actually where you should be anymore. If you like the idea of shorting off oil, you're probably looking more at the energy stocks and saying, check out this oil, then looking at the disparity between oil the barrel and energy stocks. That's probably the more interesting story. We'll do a rundown on that in our next video, so definitely subscribe. Natural gas, critical zone. Investors will be all over this level having a look at it. Not enough of a bounce or a rejection yet to say this is the low in. We are watching it. We'll come back to it. Let's move over to Tesla. Continues to sit around with these key zones here. I've still got set alert here. It did tap my zone and sold off it. I'm looking for the reaction at this point. A lot of you will be super bullish on Tesla. I'm just saying this is an incredibly cautious point. 150, 155, like when we were down here, we really just had options. Here we start to have options and we've got great technical structure. This is where I think the market is. What I said on the stream is at extreme zone 1. So extreme zone 1 basically means that it could absolutely tip over here a little bit. That doesn't mean it's going to $60, but it certainly means that it could go and fill gaps down in those 150s. It's a critical zone. If we move up here, we would be at extreme zone 2, and we would calculate those with the S&P 500. Let's have a look at the options. You'll notice the 200 strike being bought by people that don't know what they're doing, most likely. It's not that they don't necessarily make money, it's just they're all stacking into one strike. And that usually when you're doing with strikes, you prefer not to be on the one everybody else is. So make sure you follow these. It's better to be a little bit contrarian. Like even if you were above that strike or just below it during the previous weeks, this is not where you want to be. And those round numbers, especially on retail stocks, tend to be where retail traders trade. So did Apple hit an extreme zone? Yes, it did. It hit our key level up here. And of course, it's sold off so far. So this is what we call extreme 1. Extreme 2 would be higher up in the food chain. We'll talk about that should we get it. Amazon looks really bad on the charts. I got to say the weekly looks really bad. Huge rejection week. We also have that daily island that comes through. So the gap up, the gap down. At this stage, I'm looking to see whether Amazon can make it back down into those kind of 94s and seeing on the solution there. But this chart, I got to say, it doesn't look good. Maybe it'll go bullish, but everything points towards, still potential some negativity there. We move over to consumer discretionary versus staples, and you'll notice this was being one of our indicators that's just shown us there's never been a rotation into anything defensive during 2023. We got a little movement here on the last 24 hours, but we did have that huge blow up and then sell off. So we continue to watch this. If we start to see more rotation into defensives, then we have an idea that it could be Wall Street getting ready for a bit of a sell-off. Here's the Chinese market. It remains in a selling supply zone. Great run, fantastic rally, but technically people would have taken profit in this area. At the moment, could it be setting up for some kind of distribution? Continue to watch the space. This is the CQQQ, so basically the Chinese QQQ, worthwhile watching. You'll notice I've got the FTSE up today, which is the UK market. Lots and lots of little buys off here. This is a very heavily prone finance and energy and commodities and that type of thing market. I've said watch reaction here at 7706. At the moment, it's on a new high. It doesn't look like it's going to stop at this stage. However, if it does and it breaks underneath there, we'll be paying a lot of attention. I'd like to see some European indices start to fall over. And if they don't fall over, then it's going to be also tough for the US to fall over. Some stuff here where you wouldn't even think we're in any kind of even questionable recession talks. Look at those all-time highs, absolutely beast mode. If you zoom it out as well, and I don't think I've got the history here, but if you go back to the previous ones, you'll see what I mean. So go back and have a look at the history on the FTSE. Here's the Dow. It's kind of joining itself. It's basically, triangulating into a very tight coil. Because we have this triangle here or pennant, breakouts above, obviously a lot of people see that as super bullish, breakouts below, super bearish. I'm watching it, it's coiling in. Dow has been one of the most boring, it's very boring the last couple of weeks. So yeah, we'll pay attention to it and we'll bring it up should we see a breakout. Here's the Qs. Of course, we said watch the reaction up in these zones. So far, we have had a little bit of selling coming off the Qs. Expected weekly highs and lows if you wish to pause the video and chuck it in and make sure you're aware of those and stack it with your other reasons. We move over to the US 100, which is just the futures of the Nasdaq. Notice the big trend line. I really would like to see the Nasdaq sell into here. This is an area where bulls and bears will really fight it out. Basically, if you're a buyer of the dip, this type of area here is going to be very interesting for you, because if it does come down to that, we know that it's bounced many times. We also know that there's a lot of elastic demand in this market right now, even though we hit extremes on a lot of tech stocks. So for day traders, certainly a zone to be hit with. In the previous session, we saw a lot of dojis. So we saw buying, selling, small takes of the low. We'll look at it with the S&P 500. But yeah, I like down here. And at this stage, the actual technicals are bearish on the short time frame. We had that high take. We had a higher high that happened in here, which just snipped the top off, came down, pulled back, gave a nice aggressive pullback, non-farm payrolls, sold off. I'd like to see it down here. We'll find out whether that does occur. If it does end up getting a closure above here, use the S&P 500. It really could be going towards something like a 43.50. That would be pretty wild, because the markets would have further legs in them, that would say. Let's move over to the SPX. Again, you look at this and you think, well, that looks pretty negative. It bounced through all these zones. It's obviously come close to some of these areas. We now have an unfilled gap at 41.36, which still hasn't been closed. Fed Powell is coming out on Tuesday to have a chat. Maybe he pushes this in the directions to get the fills. But it's a very similar story to, realistically, the Nasdaq. We have an upward trend with bases coming through. We'll look at the futures in a second. Here's the expected weekly options highs and lows. And we know that currently the market is in rallying points. So the first thing that came off the other day, well, on the Monday, was the 61.8 fib. You can see that little bit of a bounce. You can also see the lower low. Then you can see that the market has rallied off that area, could be going towards filling the gap. Then we may see bears recommence through here. We don't quite have a hit, though, on our trend line. So the trend line's been pretty okay, similar to the Nasdaq. You can see here the nice lows that have come through, the bounces, the elastic demand. So certainly check that out. And if you take the fib from the low to the high, so this is the whole swing, notice it sticks right in this structural demand zone. And there's a lot of synergy that sits around that 40.60. We've also got weekly options lows, expected ranges not much further down below that, those kind of 404, 405 expected lows. So basically stacking that level towards bullish potential there. At this stage, though, I kind of favor maybe filling the gap and maybe that. I'd like to see that type of thing occurring. Let's move over to our most bullish case scenario here, and that is that we end up snapping the 4200 with a bullish close. I could see the market rallying to a 43.50. Might be wrong, but somewhere in here, taking out these highs would freak people out completely. So yeah, these are a pretty well stacked zone. I do like to stack areas with confluence, and there are other reasons why I like this one as well. But yeah, 43.50 should be breakout, and that's kind of the bullish case scenario at this point. What about options? Well, we know where the option strikes are. We've got 410, we've got 415, And of course, we've got 400 to watch this week. Still a lot of puts in the system. If we go through to the 17th, which is the major expiration, we know that we still have quite a lot of puts. We go through to March and we look at, I think it's March 17th is the big one. Still tons of puts in the system. This is what's making it hard to go down, and it really does make it hard. Traditionally, during February, usually what we do is we see a little bit of weakness early in Feb. We run into like the 16th. This is just traditional stats. Then we dump off at the end. So will it be a traditional Feb? We'll find out. That would then basically expire all of these Feb options on the 17th, and then we would be able to sell into the March period. Watch it, know the stats, and then of course, if it's happening with your technical analysis, hey, you can pay attention to it. Let's move over now to Bitcoin. We have a dulling market in the zone. No selling yet in terms of technicals because we haven't made a low underneath these wicks yet. 22,289 still on the watch list. Still watching the set alert here. Imagine if we hit this, we hit like a 43.50 on the SPY. Everything's going crazy. Yeah, very, very key levels to potentially become contrarians on the market. But for now, Bitcoin still remains in a holding pattern. And although it looks a little bit negative, it's dull. And they say don't short dulling markets. And at this stage, there's no real reason to. In terms of the news for the week ahead, we've got Fed Chair Powell being annoying, 12 p.m. New York time, Feb 7th. Then we have FOMC member Williams speaks, and that's on Wednesday, and that's at 9:15 New York time. Then we scroll through and we get the prelim UOM consumer sentiment at 10 a.m. Friday, Feb 10th. So a little bit of news, definitely some earnings, and quite a lot of stuff happening on the markets right now. Do remember to subscribe to the channel if you like it. Make sure you smash that like button, and of course, follow us on any of the other socials if you're interested in finding out more about our content and hopefully providing you a little bit of edge in those markets. Thanks so much, guys. We'll see you in the next one.